Ladies and gentlemen, welcome back to GoldTime Tracker. My name is Dennis, and on this channel, we focus on one thing only: truth in gold and silver markets. No hype, no distractions, just real data, real history, and real-world implications. If you're here to understand where money is truly headed, not where headlines want you to look, then stay with me till the end of this video. Let me start with a question that most investors never seriously ask themselves. What happens to your wealth when the currency itself is the problem? Because right now, the biggest risk in the global financial system is not stocks, not real estate, not even bonds. It is money. The dollar and every major currency tied to it is being expanded at a pace that history tells us always ends the same way. When you compare gold to the expansion of currency supply, especially M2 money supply, a very uncomfortable picture begins to emerge. Gold has not kept up with the sheer volume of currency creation. In fact, from where we are today, gold has roughly a 4.5 times revaluation potential just to reflect inflation-adjusted reality. That's not speculation. That's math. Now here's where things get interesting. If gold merely doubles from current levels, that 4.5 factor turns into something far more powerful when measured against the dollar. And when silver moves alongside gold, as it always has during monetary resets, the gains are not incremental. They are multiplicative. History has already given us a clear blueprint. During the global financial crisis between 2007 and 2011, most people watched their net worth evaporate. Real estate collapsed by nearly 50%. Equity markets were crushed. Confidence vanished. But during that exact same period, gold didn't just hold its value, gold tripled. That divergence is not an accident. It happens every time trust in financial assets breaks and capital seeks refuge in real money. And today, we are once again surrounded by warning signs. Markets are sitting in what can only be described as hyperbubbles. Asset prices are disconnected from fundamentals, propped up by cheap money and belief. But belief is fragile. When it breaks fast. By the end of 2026, a significant market correction is not just possible, it is likely. We have seen this movie before. This brings us to silver. According to inflation-adjusted data, silver is currently only 11.8 times away from its M2 adjusted all-time high. In simple terms, silver still has nearly 12 times upside potential relative to currency expansion alone. These are not paper gains measured against other assets. These are currency gains, silver versus the dollar itself. That is why serious analysts are now openly discussing triple-digit silver prices. Some say by 2026, some say 2027. The exact year matters far less than understanding the direction. Once this process begins in earnest, it does not stop politely or move slowly. And unlike previous cycles, this time the system has a critical problem. There is no silver stockpile left to bail it out. For decades, governments quietly sold strategic silver reserves, assuming they would never be needed again. That assumption is now proving catastrophic, because silver is not just an investment metal, it is a monetary metal, an industrial metal, and a strategic metal, all at the same time. And that combination changes everything. What is happening in the silver market right now is not normal, and it is not temporary. It represents a structural shift that most investors are still failing to grasp. Silver is quietly being reclassified by governments and institutions around the world, not as a commodity, not as a trade, but as a strategic resource. One of the clearest signals came from China. China has now moved to restrict silver exports through licensing requirements and tighter state control. This is not about market efficiency. This is about resource security. When a country with massive industrial demand and refining capacity begins to control the flow of silver, it tells you everything you need to know about future availability. And here is the uncomfortable reality. Global silver stockpiles are largely gone. Most people assume that governments still have vaults full of silver ready to stabilize the market if prices rise too fast. That assumption is dangerously wrong. The United States once held the world's largest silver reserve, officially known as the Strategic Silver Stockpile. Over time, that entire reserve was sold off, not reduced, not replenished, completely eliminated. Today, there is no emergency supply. This matters because silver is no longer optional to modern civilization. You cannot fight a conventional war without silver. You cannot fight a technological war without silver. And you absolutely cannot fight a monetary war without silver, because silver has served as money for thousands of years. Unlike gold, silver has a unique problem. It is consumed. Large amounts of silver are permanently lost every year in electronics, solar panels, medical equipment, advanced weapon systems, electric vehicles, and digital infrastructure. Once it is used, it is often uneconomical to recover. That makes silver fundamentally different from almost every other asset class. At the same time, supply is disappearing, demand is accelerating. Renewable energy initiatives alone require massive quantities of silver. Advanced electronics and AI infrastructure are silver-intensive. Military technology is silver-dependent. And as geopolitical tensions rise, nations are beginning to understand that control over strategic metals is just as important as control over energy. This is not theory. It is already showing up in public behavior. Search data now shows a sharp surge in interest around how to buy silver, reaching levels last seen during major financial crises. Historically, these spikes have aligned with critical moments in the silver market, the aftermath of 2008, the 2011 peak, and now again. The difference this time is simple but profound. There is no excess inventory to absorb demand. In previous cycles, rising interest collided with large above-ground stockpiles. This time, it is colliding with empty shelves. That is why price suppression becomes increasingly fragile in this environment. Paper contracts can be created endlessly. Physical silver cannot. When physical demand overwhelms available supply, price discovery eventually breaks free, no matter how long it is delayed. Silver is also beginning to reassert its role as a monetary metal. As currencies weaken and trust erodes, investors instinctively return to assets that cannot be printed. Gold leads that move, but silver historically outperforms during the later stages of monetary stress because of its smaller market size and dual demand. This combination, shrinking supply, rising strategic importance, industrial dependence, and renewed monetary demand, creates a setup that is extremely rare. It is not something that appears every decade. It appears once in a generation, and most people will only notice it after prices have already repriced dramatically. Silver is positioned for such an outsized move. You have to step away from short-term price charts and look at one of the most revealing long-term indicators in the entire precious metal space, the gold-to-silver ratio. This ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. On the surface, it sounds basic. In reality, it captures something far deeper: relative scarcity, market stress, and monetary psychology. When we go back over decades of data, a pattern becomes very clear. During periods of financial stability and abundant supply, the gold-to-silver ratio tends to hover around historical norms. During periods of monetary stress, scarcity, and currency debasement, that ratio doesn't stay elevated, it collapses. In the 1970s bull market, when silver stockpiles were still enormous and governments held vast reserves, a ratio in the 30 to 35 range was considered normal. That was during a time when silver was plentiful. Fast forward to today, and we are sitting at ratios more than double that level, despite the fact that above-ground silver inventories have largely disappeared. That imbalance makes no sense. The most extreme example occurred in January of 1980. At the peak of the last great precious metals cycle, the gold-to-silver ratio fell to around 14 to 1. That was not a coincidence. It was the market acknowledging silver's monetary role at a time of severe inflation and currency stress. Today, we are approaching a similar environment, but with one crucial difference. In 1980, there was still plenty of silver available. Today, there is not. When you look at the ratio from a long-term perspective, going all the way back to the early 1970s, you see that the current level represents an extreme distortion. From the mid-1980s until now, the ratio has oscillated around an average range, occasionally spiking during crises and then reverting. What matters is this: every time the ratio reaches extreme levels, it eventually corrects violently. This is why I often refer to this as the silver opportunity chart. The higher the ratio, the greater the opportunity. Not because silver is falling, but because it is being undervalued relative to gold. When fear dominates markets, silver is sold harder than gold. But when confidence breaks in currencies, silver catches up and then overshoots. This is where emotional discipline becomes critical. During market panics, most investors do the exact opposite of what history rewards. When silver collapsed during the pandemic, prices fell into the low teens. Fear was everywhere. Headlines screamed that silver was finished, but that was not a signal to sell. That was a signal to accumulate. Opportunity was expanding, not shrinking. Successful precious metals investors learn to act against emotion. When prices are low and sentiment is negative, opportunity is high. When prices are euphoric and everyone is chasing momentum, opportunity is shrinking. Personally, I've always paid close attention to this ratio. When it moves into extreme territory, it tells you something important. Silver is being mispriced. And mispricing never lasts forever. As the ratio begins to fall, and it already has, it signals the early stages of silver outperforming gold. This does not happen in a straight line. There are pullbacks, there are pauses. But the direction is clear once the trend shifts. The most important takeaway is this: silver does not need perfection to move higher. It only needs the ratio to move back toward historical reality. And if it overshoots, as it has in every major bull market, the gains can be extraordinary. Once you understand the gold to silver ratio, the next piece of the puzzle becomes impossible to ignore: compounding gains. This is where most investors completely underestimate what gold and silver are capable of during monetary resets. Let's start with gold. Based on inflation-adjusted currency expansion, gold still has roughly a 4.5 times revaluation potential from where it sits today. That number alone is significant, but gold rarely moves in isolation. When gold begins to reprice against currencies, silver does not simply follow, it amplifies the move. Here's why. If gold merely doubles and the gold to silver ratio continues to compress toward historical norms, silver doesn't gain 100%. It gains multiples. This is not leverage in the risky sense. It's structural leverage created by a much smaller market, tighter supply, and dual monetary industrial demand. History gives us a very clear case study. During the global financial crisis from 2007 to 2011, traditional assets were devastated. Real estate prices fell by roughly 50%. Equity markets collapsed. Credit froze. But while paper assets were being repriced downward, gold surged and ultimately tripled. Now imagine what that allowed. If someone had sold a property near the top of the real estate bubble and moved that capital into gold, then waited until real estate bottomed and rotated back, the results would have been extraordinary. For every home sold, that individual could have purchased multiple similar homes at the bottom. That is not market timing. That is capital rotation during a reset. These cycles are not about guessing the exact top or bottom. They unfold over years, not days. That is why they offer repeated opportunities rather than one perfect moment. Monetary resets are slow burns, punctuated by sharp repricing events. Silver adds another layer to this dynamic. As gold revalues upward, silver historically begins to outperform in the later stages of the cycle. Its smaller market size means it takes far less capital to move prices dramatically. At the same time, industrial demand does not pause just because prices rise. In fact, during technological expansion and geopolitical competition, silver demand often increases. This creates a rare situation where monetary demand and industrial demand reinforce each other instead of competing. When you combine gold's role as a monetary anchor with silver's leverage and scarcity, you create a setup where gains are not linear. They are compounded. Gold rises, silver outpaces gold, and both rise against a falling currency backdrop. This is why comparing precious metals to stocks or real estate in isolation misses the point. Gold and silver are not just assets, they are measuring sticks. They reveal how much purchasing power currencies are losing. As currencies weaken, metals don't go up, they simply reprice. What makes this cycle especially powerful is that other asset classes are once again stretched to extremes. If equities, bonds, or real estate correct while metals reprice higher, the relative performance gap becomes enormous. This is not about short-term trading, it is about positioning capital where it benefits from systemic change rather than being destroyed by it. One of the clearest signs that the silver market is entering a new phase is not found on price charts. It's found in behavior. Specifically, the behavior of large, well-informed buyers who understand that physical silver is not the same thing as paper silver. Recently, reports have surfaced of individuals and entities exploring nine-figure silver purchases, not ETFs, not futures contracts, but physical delivery. When someone starts asking how to acquire $100 million worth of silver, that tells you something important. A few people are beginning to see what's coming. Silver is moving from being scarce to being unobtainable. And when a metal becomes unobtainable at current prices, the next stage is what I call unaffordium. That's when supply technically exists, but only at prices high enough to force demand destruction. That is how markets clear shortages. Not politely, violently. What makes silver especially vulnerable is that it cannot be conjured into existence the way paper claims can. Futures contracts can be created endlessly. Unallocated accounts can multiply overnight, but physical silver must be mined, refined, transported, and delivered. And refineries are already struggling to keep up. This is why we are seeing increasing stress in the physical market. People are cashing in silver at the same time others are trying to secure large quantities. That creates bottlenecks. And once those bottlenecks appear, they tend to cascade. Premiums rise first, then availability disappears, price follows last. We've seen this movie before, but never on this scale. Some have compared the current situation to the Hunt Brothers episode of 1980, but that comparison actually understates the risk. Back then, a small number of players attempted to corner silver in a world where governments still held large reserves. Today, imagine hundreds of Hunt Brothers spread across the United States, China, and the rest of the world, all demanding physical delivery. This time, there is no stockpile to stop them. At some price level, silver will become available again, but it will not be at today's prices. Maybe it's $200 an ounce, maybe $300, maybe far higher. The point is not the number. The point is that price is the only mechanism left to balance demand and supply. Another area of massive misunderstanding is so-called junk silver. Most people have no idea what their old dimes, quarters, half dollars, and silver dollars are actually worth. These are not collectibles. They are fractional silver money. And during periods of monetary stress, fractional silver becomes extremely valuable because it is recognizable, divisible, and trusted. When silver was trading around $57 an ounce, many still underestimated the real value of their junk silver holdings. That ignorance does not last forever. Education spreads, awareness grows, and once the public catches on, supply tightens even further. What we are witnessing right now is the early phase of a physical drain, not panic, yet, but purposeful accumulation by those who understand that silver's role is changing. This is not about trading dips. It's about securing something that may not be easily available in the future at any price. When people talk about gold and silver, they usually frame the conversation around profit, prices, targets, charts. But history shows us something far more important. Precious metals are not just about wealth. They are about stability. Every major currency crisis has followed the same script. First, money is debased slowly, almost invisibly. Then, trust erodes. Then asset bubbles form. And finally, when the system breaks, the middle class pays the price. Savings are destroyed, purchasing power collapses, and fear fills the vacuum. It is during those moments that societies become unstable. History is very clear on this point. Periods of severe currency and financial stress are often followed by the rise of authoritarian figures, not because people suddenly change, but because desperation makes populations vulnerable to anyone promising certainty and relief. This is how power concentrates. This is how freedoms erode. Sound money has always acted as a counterweight to that process. Gold and silver don't just preserve purchasing power, they preserve choice. They give individuals time, flexibility, and independence when systems fail. That is why they have survived every empire, every collapse, and every monetary experiment. What we are seeing now is not just another market cycle. It is a monetary reset in slow motion. Silver's resurgence is not happening in isolation. It reflects deeper stresses in the global financial order: unsustainable debt, endless currency creation, geopolitical fragmentation, and technological competition. Silver sits at the intersection of all of it: money, industry, and strategy. When precious metals rise during broader asset downturns, their impact can be transformative. We saw this during the global financial crisis. While real estate collapsed and equities suffered, gold surged, allowing capital to be repositioned at extraordinary advantage. Similar dynamics may unfold again, not as a single event, but as a multi-year process with repeated opportunities. This is not about timing a perfect top, it's about positioning. Gold may double, triple, or more as currencies adjust to reality. Silver, if it reverts toward the historical ratios while supply remains constrained, has the potential to outperform everything else, not because it is speculative, but because it has been structurally mispriced. Eventually, silver will move from being ignored to being chased, to being feared for its price. That is how every precious metal cycle ends. The only question is whether you recognize the shift early or only after the repricing is complete. At GoldTime Tracker, the goal has never been to tell you what to think. The goal is to help you see what is unfolding so you can make informed decisions for yourself. Because when the reset is obvious to everyone, the opportunity is usually gone. The information presented on GoldTime Tracker is for educational and informational purposes only. Nothing in this video should be considered financial, investment, legal, or tax advice. I am not a licensed financial advisor. All opinions expressed are my own and based on publicly available information and historical analysis. Precious metals markets, like all markets, carry risk. Past performance is not indicative of future results. You should always conduct your own research and consult with qualified financial professionals before making any investment decisions. You are solely responsible for your financial choices.